Yes, so I have done the post. So shall I share the screen right now or once Winston
Um,
starts speaking?
sure. Once he starts, I'll just do a quick introduction.
Sure.
Okay. Okay, good evening, everyone. Welcome. My name is Gina Nelson. I am the founder and CEO of Bella and Bella Productions. We are a UAE-based media and advisory platform that's committed to amplifying not only female-led ventures here in the UAE and GCC, but also enabling cross-border collaborations across finance, business, and innovation. So through our advisory arm, Bella and Bella Advisory, we're helping facilitate partnerships between institutions, investors, and entrepreneurs across global markets. And tonight's webinar in particular is an exciting collaboration between us at Bella and Bella Advisory and our esteemed partners who you're going to meet shortly at Complex Capital Solutions Group, who are based in New York and New Jersey. Together, we're launching this new series of conversations that are designed to explore high impact financial strategies for global high net worth individuals and institutions. And our focus this evening, life insurance and premium financing strategies for global HNWIs in 2025, is just the beginning of these conversations. We'll be sharing insights on how families, fund managers, advisors can leverage premium financing to preserve capital, manage estate risk, and maximize legacy planning in today's ever-evolving financial environment. So without further ado, I'm going to turn it over to our partners at Complex Capital Solutions Group, Winston Way and Jerry Chambers. Just in terms of housekeeping, we'll actually go through the presentations for about 30 minutes and then take Q&A at the end. Feel free to put your questions in the chat and you can unmute yourselves at the end of the session. So Jerry and Winston Way.
Thank you, Jan. Jerry, why don't you start a quick intro? I'll do a quick intro. We get going with the presentation.
No problem. Yeah, Jerry Chambers with Complex Capital Solutions. I've been in business over 40 years, and Winston and I linked up about a year and a half ago and joined his firm, learning all the strategies that he's been doing for the last 30 years, I guess, with restricted property trust and premium finance and dealing with high net worth folks in terms of tax mitigation and wealth building and legacy planning. And we're linked up with Bella Bella. We're happy to be trying to do work on a cross-border basis, and we're hoping to continue to build on this relationship and get some of this information out on an international basis. So that's it.
All right, thanks, Jerry. My name's Winston Way. I'm the founder and CEO of Complex Capital Solutions. I'm in the financial service sector over 45 years. And one of the things we want to do with our clients, both domestically and globally, is provide them objectivity solutions that, either wealth managers, family offices may have in the local country or in U.S., ability to have more access to different options, pricing, plan design, etc. So we're fortunate, Complex and Gina and her team, Bella and Bella, are able to partner this strategy over long term because we feel like education is very powerful. Let them understand what's available because we're independent, so we don't affiliate with any specific company. So we have access to the entire marketplace in U.S. Life insurance company as well as many foreign national companies. So if situation arise, that can be a separate conversation. We can address either way. Okay. So we have about there's probably like 200 insurance company in U.S., but we only deal with top 15 A+ rated or A solid companies, 80, 150 years in the business, financially strong. The reason that is very important, especially for global clients. Not only brand names important, but what's the underlying product and costs and expenses within the plan designs. So we'll go over that. So I'm going to break up into three parts today. It's usually one part, but we figure we'll do each one like 10 minutes. First one will be life insurance premium financing, and I'll talk about some case study and some statistic. Then second one's understanding index universal life. And the third one's understanding how borrowing rates with premium financing. As Gina mentioned, we'll leave the Q&A towards the end for anyone that want to ask questions on those three topics. Let's get started, Mary, with the PowerPoint.
Hmm. Are we having problems with the PowerPoint?
Looks like it's loading.
It's
Oh, there we
coming.
go.
Yeah. I think it's trying to get to the presentation mode.
Swarnam, do you want to try again? See if we can get it.
Are you able to see the screen now?
No, it's loading. I saw this other screen before it became big screen, the smaller screen. If not, we can use the smaller screen.
How about now?
That's the small screen, but we can use this if we can get into the big screen. Is that okay, everyone?
Yep.
Okay, so the title of this first presentation, Life Insurance and Premium Financing for global high net worth. Next page. So we're going to do an overview of life insurance, understanding premium financing strategies for high net worth in 2025, what are different trends and some case study. So the next page is overview of life insurance. Okay, basically the purpose of anyone that's on this call is to get an understanding of what life insurance is. I know you have them in the local countries. It works the same way. It's building legacy for life insurance to protect, grow, or the purpose. It could be a protection for the family, could be for estate planning, taxes. Every country has different jurisdiction on how taxes are paid upon a person's passing away. Asset allocation, should this be part of an asset class for your overall financial planning? Or if it's a business, do you need life insurance to protect the business, whether it's a partnership agreement, key person, etc. Uh, and the last thing on the life insurance, do you want it to be a temporary life insurance or permanent? So we'll go over that. Next, please. So basically, there are three types of life insurance. Within each one, there's different formats. So, for example, in term insurance, which to us it's called rental, temporary. That's why it's called term. There's a period from 1 year, 5 year, 10, 20, 30, or even 40 years. These are the type of term they have in the United States. Most of them maxed out at 30 years. There's a few companies that will go 40-year term. What that means is when you get approved from underwriting, whatever the cost and the face amount you purchase at that time, it will lock in the term years, 10 years, 20 or 30. And then once the term year expire and you're still, healthy, the rates either become substantially quadruple what the original rates are, or you will, or it discontinue. It depends on the company's product. The second category is whole life insurance. It's fixed premium. It's designed to be conservative. That means it's only invested in long-term bonds and government securities. There's no market exposure. There's no S&P. There's no stock and bonds, etc. And it's designed for someone that wants conservative, that wants to have like something very almost guaranteed, because nothing is guaranteed in whole life because dividends are not guaranteed. But we only pick the companies that are solid mutual companies that offer the dividends. Okay, there are companies that offer whole life, but it's a stock company whole life, so the dividends go to the shareholder versus the policyholder. Third one is universal life. It's called flexible premium. Within universal life, there's four different types of universal life. There's fixed universal life that's invested in guaranteed interest rates similar to fixed CDs. There's a GUL, it's called Guaranteed Universal Life. You're buying a fixed premium that can last you 50 years, 60 years, by really not building up cash equity on those policies, but it's guaranteed the premium stays the same for the years you pick. And as long as you don't lapse the policy, the guarantee stays in. Then there's a variable universal life where it's invested in the stock market. It could be in different formats of commodities, different type of strategies, but it doesn't protect the down market. What that means, when the market goes up, the cash value in the universal variable life can go up as high the market goes. But when the markets go to negative, you lose it as well. So the ones we like the most, if someone's looking for permanent with some equity growth, is index universal life, which is invested in different format of S&P 500. We'll expand that a little bit more in this topic. Okay, so these are the basic three types of permanent life insurance that's available for us to offer to our clients. Next, please.
Winston, hold on one second. I'm going to
Sure.
share just so we could get the full screen. So,
Okay.
Swami, let
Sure.
me just, let me try that. Okay. Just so we could have the full, okay. Tell me when everyone can see. And welcome to everyone who's joining us. Give me 1 second. I'm just going to. Okay, so apologies that it's taking us. So slideshow, can everyone see in slideshow view?
Yes, perfect.
Okay, so here you are.
So we mentioned already previous about real quick estate planning for high net worth clients who are doing legacy planning or they're structuring the wills and trusts and they want to set up where a good portion of their assets do not go to their equivalent Uncle Sam in U.S. In their own country. We will coordinate with your attorneys or financial advisors to come up to make sure everything's done properly. Then you have the tax advantages for high net worth that want to use this as an asset class to let this asset grow on a tax deferred basis. And we can also design it where it becomes tax free as well. Liquidity for beneficiaries. If someone has allowed their portfolio tied in real estate or businesses that's not liquid, and if something did happen to the breadwinner or the high net worth individual, if there's a tax liability due, the last thing the person want to do is have the family liquidate their non-liquid assets to pay taxes. So life insurance is one liquid way to do it immediately with no, difficulty of any politics to get funds immediately to the family. And wealth transfer. Okay, next page. Current trends in life insurance, anything with AI, everything else, investment in technology from all the major insurance companies has been very robust. Customer experience, there's a click, you get all the service thing you need besides going through us. Initially, if there's an emergency need, you need to get something in customer service information from your policies can be done. There are hybrid insurance products out there that 20 years ago, 15 years ago is not available, and we'll address that. Next page. Understanding premium financing. Actually, Gina, before we go into this, I want to spend a couple minutes because when we talk about life insurance, it can be two ways to fund it, right? One is client has the cash flow, they just pay out of pocket. Okay, we actually have two cases now from international client. One client is from Asia. The son's actually was studying in one of the university in California and now has a job. So that created what they call U.S. Nexus. they need to have some kind of tie to US, okay? And we can cover that towards the end if there's a question come up. So the mother just want to buy a $2 million index universal life. He says, you know what, just give me $2 million. I have some other insurance for my own country, but I want to pay it for only 10 years. So no financing, very simple. She write a check. In fact, the funding just came in last week. So the funding and the design is for 10 years. We have a new case that's coming in now. Another family from Asia. This one, they have real estate in U.S. already, so that create the U.S. nexus. They have bank accounts, so you only need one of the many lists to qualify for that. So she's looking for $8.5 million index universal life, but only paying 5 years. So this case example is not financing, okay? And we'll talk about the difference between those. So let's go to the next page. So financing is basically someone who has a lot of high net worth, but they prefer to take the money and invest in business or real estate or a different project. They rather use leveraging, let the lender pays the premium. Okay, so that's why it's called financing, where we have multiple lenders based on the client's net worth and balance sheet. There's no limit how much we can lend, and it's only designed for high net worth individual. So the sweet spot they're looking at is 10 million and up global net worth to really look at this category, and someone that can also post collateral if it's going to be 100% finance. Okay, so we have a case now, Jerry, now when a client, the 52 years old, he's heavily tied all his assets into real estate. He managed about 160 apartment units in California, and but he needs to protect his family legacy because his net worth is about 60 million. And if he doesn't do any planning, what would happen if something did happen to him? Because right now he's not married, so the U.S. tax law works as till end of this year. We don't know if that will change. Anything on a single person, anything over $14 million, the first 14 million is exempt. So if he has a $60 million net worth minus the 14, let's say something that happened to this person this year, there's $46 million that's exposed to estate tax. So you have two form of taxes. You have the federal, which will be 40% of that amount, which is substantial. Second is he lives in the state that there's state debt tax. So you add that on top. So it could be about 45 to 50%, depends what state you're in. If you're in California, New York is over 50%. So that means if he doesn't do any planning, that 46 million minus maybe the 50%, half of that is taxed. So that means the family or the beneficiary on this family on his side would have to liquidate all those apartment units to pay the tax, right? And all the hard work put in, renovation, all the buying, selling, it'll basically go to waste because Uncle Sam gets it, right? The life insurance allow this person to leveraging. So he's looking at $20 million and he's contemplating either funding it where it's 100% finance with collateral, or he's going to put up maybe half upfront, half finance. So that's a plan design that we customize to each individual high net worth person. Next page. Advantage it, you cash retention, as I mentioned, tax benefits. Designed properly, let's say the same $20 million, it'll be owned by a trust, irrevocable life insurance trust. So that means if something did happen to the insured, the $20 million will not be taxed at all. It'll be federal income tax free, estate tax free, state income tax free as well, because the trust owns it. It's out of his or her estate. You can buy a larger policy by financing. So let's say you say, initially I'm looking for $10 million life insurance, and but you have the ability to do financing. We might be able to get you the same cost for the 10 million out of pocket to maybe give you $25 million life insurance because of the leveraging. Next page. What are the risk consideration? Interest rate fluctuation, loan defaults, risk evaluation. So this is a good situation now. So prior to COVID, loan rates was very competitive, I think globally. Okay, but then when pandemic hit and everything happened, interest rate went up substantially the last few years, starting to go down. So if someone's looking to do financing, there's someone to understand the risk, and they say, you know, I can go through the upwards and downward swing in the interest rate environment. Loan default is only if someone can no longer, you know, fund the policy or pay the interest payment. Okay, so we evaluate each person carefully. We give them the option whether it's financing makes sense or non-financing makes sense, or you do both. Some client may do half finance, and some pay insurance policies separate, like a 5-pay, 7-pay policies. Next page, please. Strategies in 2025. Next. So we customize to your needs. So let's say after the call, anyone that's interested to learn more about it, or for us to give you a customized design, please reach
Dr.
out
G,
to Gina's team.
I can't answer this call.
I'm sorry.
Well, like somebody's trying to call in.
Okay. So shall I hold off on us? Wait. Okay, let me continue. Okay. We customize, as I mentioned, we set based on your financial goals, your family goal, or your business partners, whatever your goal from the big picture. And if you're a family office advisor, we'll work with them to coordinate it. Uh, or we could make a compliment to what you're doing as a part of your team. Um, and to make sure you have the right strategy, the right carrier, the right type of plan that meets the goals. So it's all customized. Next, please. You can skip this. We went through that innovative stuff. We all have all this new AI stuff, or the companies are very technology in mind. We also make sure everything's compliance. So, for example, the case we're talking about, the $20 million, one of the insurance company we recommend based on his risk tolerance and experience in dealing with this type of recommendation is we went to multiple companies. We find a company that fits him the best. But this particular company, before they even consider it, we need to do a pre-application to give them the information, the background. I need to put a cover letter. Is this suitable for this client to consider financing? Okay, so we make sure the risk mitigation strategy is there, the compliance looked at it, because the last thing we want to do is give a plan to the client, and a year from now they can no longer fund it because they weren't aware of the risks and good pros and cons. Next, please. Global trends. So you got the raw interest rates, the market, the political environment right now, the last many months, but those are cyclical, so those will change. But if the business owner, high net worth clients, ultimate goal is to preserve their asset, right? Uh, Most clients will use life insurance as a tool because it's the least expensive, the most simpler, but a lot of the global high net worth client would like to have some of the asset class mix in US dollar denomination. That's where we come in and offer that strategy. Next, please. Skip that. Changing, we went through that, we can continue because the next two chart, the PowerPoint, there'll be some overlap anyway. So here's a case study on the premium financing. So this couple in New York, they're a very successful business. They own multiple daycare business, adult daycare. They serve a senior community. The goal for the business owner is they have 3 adult kids. Okay, there's enough asset and legacy to pass on to them already. So they say, we don't want to invest in, like real estate portfolio, anything like that. They just want to use the life insurance as the retirement planning. Okay, so over the last 7 years, we created for the husband, he was I think 48 at the time he started. We did three separate premium financing policies. One was a $5 million, one was a 10 million, one was a 15 million. So the husband has 30 million combined of life insurance through financing, and he had some other non-financing policies before we met. And then the wife, we did $20 million financing. And this design was 100% financing. So they just post collateral, which collateral is a asset that's given back to them once the funding is sufficient with the cash value growth. So the collateral is a temporary part of some of their assets. Okay. So that particular client, by the time they retire, the lending will pay about $1.8 million on the combined $50 million policy. And when they retire, I think it was 60, 62, the design will give an ultimate potential retirement income about 1.5 million a year tax-free for them for like 25 years. So they use that as their one of the retirement planning. Next page. Lesson learned, best practices, common pitfalls to avoid. So I think a lot of this, if there's interest from any of the people in the audience, when we do a customized phone call after this session in the next few weeks, we'll be glad to go through more detail. We can customize design based on what you want, walk through it page by page to make sure you fully understand how that works. Next, please. Leveraging life insurance is one option, premium financing, navigating the future of what if potential future challenges that face all of us. Next page. Okay, conclusion. Let's go to the next one, Gina. Due to time.
Give me 1 second. I'm just gonna.
Okay.
Hi, Dean. How are you? Just need to close this one and share the other one. Understanding the borrowing rates, right? Okay, there we go.
Yes.
Okay.
Okay. Okay, next. So, as I mentioned a few minutes ago, when you do financing, you can do 100% finance based on the individual's financial balance sheet, liquidity, and based on the amount of life insurance the high net worth individual is looking to purchase. Assuming medical exams come in, fairly good, preferred rate or standard, then the lender will look into, getting the financing started. If it's 100% finance, they will need the paperwork, bank statement, tax return, investment portfolio in the last couple of years. And then they'll go through like a normal way a lender would, purchasing a building or something to get finance. Okay. Implication of borrowing rates will change. We will at that time look at what the lenders are, what's the best favorable rates available for the client. Next page. Some of this is overlap. Continue. Again, this you can skip this. We went through that. Cash flow management, interest rate fluctuation, mentioned that, loan management. Okay, next. Key stakeholders on this. Okay, policyholders' role. So if you're the insured, that's one key role. The lender contributions, one key role. The insurance company function to provide a product that fits in to the design of the premium financing based on how you want to set up the design that we help with the client. And the financial advisor's guidance, we can either coordinate it with your wealth manager, as a family office person, or if you don't have one, we'll be the quarterback to work with your CPAs or attorney. But if it's a foreign national case, we will need to have a U.S. attorney to draft a trust. Okay, but there'll be an opportunity to do a letter of power attorney to deliver the policy. Okay, next page. Mechanics of borrowing rates. So credit worthiness of the borrower, lender's policy, market conditions, financing agreement. Okay, all our financing are non-recourse loans, and there are some you can get annual rate renewal. You can lock in for 5 years, 7 years, 10 years, depends on the environment at the time we finalize the policy and the loan design. Okay, next please. Type of financing, fixed rate, variable rate, choosing the right rate. Okay, next. Calculating borrowing rates, amortizing schedule, financial calculators, accessing financing option. So let me go through now the last 30 years because that's important, okay, in US. So most of the lenders we work with use a 1 year US Treasuries plus a spread. And in the last 30 years, the high has been as high as 8.27 on the loan rate. The low has been 2.5 during 1995 to 2024 as an average. But the last 30 years, the borrowing rate is 4.94, so it's less than 5%. So it's pretty good if you look, because when you're doing life insurance planning, you're looking long term, right? You're not looking for 5 years, 7 years, especially if it's retirement planning, estate tax planning, you're talking about, to mortality or 60, 70, 80, 90 years old. So it's a long time. So over the time frame, the average is fair. Okay, if you went in 2.5 years ago, initially it would be like high sevens. Then you might say, "Oh, it's too expensive," but it's not going to stay at high sevens because every year, when you do renewal, the lender will look at what the market rates is and give you. If it's lower, they give you the lower rate. Next page. Raw interest rate, same thing. Impact on borrowing costs, market interest rate trends, staying informed. Okay. So good. On this part, let me tell you from U.S. standpoint. Okay. About 10, 15 years ago, many major banks decided to go into the space of premium financing because they think it's a good way to generate more business opportunity. But over the last 6, 7 years, many major banks got out of premium financing because they feel like that's draining the reserve for the banking purpose. So they sold the book of the business to some premium financing company that strictly focus on the area. So we tend to try to work with lenders who are not tied into a bank. I mean, if you have, I had a lunch meeting with a top individual at Bank of America on the private banking side 2 weeks ago. So he's one of my clients' advisor on the banking side. So we sat down and said, by the way, will you take premium financing? No, we don't do it, right? So if they do it, if a bank that does it, sometimes because if a client has $5-10 million of their asset invest with that bank, if the bank has the premium financing capability, I want to do it, they can offer a lower rate initially than probably outside bank, but we don't know how long the bank will continue the financing. That's the issue, right? So we want to go with a firm that's more stabilized, that's been doing for many years, and that's their primary business. Next page. Loan structure is very important, repayment terms, interest calculation. So it depends if clients looking to put some funds in the game, skin in the game, what we call it. So it's not fully 100% financed, so the design will be slightly different than others. Interest calculation is projected. So right now, when I project certain amount, it will show as an average declining. then you'll see overall exposure of costs from interest payments to the plan being funded and being paid back to the lender. Next. Next. So I'll give you a case right now. So I like to share case studies, which are live cases or real case in terms of, so this particular one, interesting individual, he's a US citizen. He owns two boutique hotel in Manhattan, very expensive and very successful or high target location. And he also owns a bunch of different real estate. He's probably worth 50, 60 million. So his situation was he's 67. Uh, his spouse is probably 15 years younger. So the kids are young in high school age, right? And his goal is to make sure to preserve the assets of all, the hotels and everything. All and still Uncle Sam becomes the partner. Plus, he's a New York State resident, so you're talking about 50% off the bat in taxes. So initially, we were looking at doing premium financing for him for $8 million face amount. Everything's got approved, and then he looked at, because he's 67. He said, "You know what? Let me just not financing." So it can go either way, right? We can start off doing both design, and he ended up saying, "You know what? Let me just pay out of pocket 255,000 a year for this policy." So by the time at the end, he ended up increasing to 10 million from 8 million. We got him reapproved for 10 million. So he'll fund 255,000, but in his mind, he had health issues. So that's why when we talk to a client, we need to kind of understand the whole big picture. What's the health history, family history, personal health history, to make sure how we design properly. So in his case, I think 13 years ago, he had a severe illness. That's when I Googled the term of the medical terminology, it was like a 6 months mortality at that time. So fortunately, the surgery happened a year after, everything's fine. But he still have to do a quarterly checkup. So from insurance standpoint and risk, they do see a risk because he had that track record in the past. Plus the client know his mortality might be different than someone in 67 that's never had a health issue, right? So he want to make sure the policy he gets will at least go to age 100. Okay, because what's the purpose buying if he buys it and 4 years later, or if he buys it, it lasts to 120. But he said, as long as I go the policy can guarantee to 100, I'm fine. So that's all customizable, right? On the design. Next piece. Policy performance. We're going to cover that more on the last session. Next. So our goal in our end is negotiating the lower rates for you, optimize loan structures, explore financing options. So when we sit down with a client, we will do multiple meetings, whether it's Zoom or depends on the location, and we'll go back and forth, make changes accordingly, coordinate with uh, your advisors, and then at some point to set up a trust. If it's a global high net worth, we'll make sure everything done in a seamless manner. So let's say you, as a high net worth, decide, I like to look at life insurance to buy U.S. product, where it's financing and non-financing, right? You do have to come to U.S. You can come for 1 day, 2 days, like some of the clients, and we have to establish some kind of U.S. nexus. So what we can do is, Gina, so anyone interested in some more detail about the process, or we can do another session in the next quarter on the process. What's the steps needed to do it? We have clients come in 3 days. And with as long as they want a U.S. Nexus, we get the medical exam done. We have our own doctors. We're gonna have to trust at least preliminary set up with a meeting with the attorney, and we do the application. So when you go back, the process started already. Okay, so in between stuff, we can get records while you're back in your home country. Next page. Okay, next. So we feel like now in US anyway, the the economic's changing. We're starting to see loan rates for financings to go down. And hopefully the next couple quarters, there'll be some additional consideration from the Fed to reduce rates, loan rates. That will also help with the financing. Okay. So I think we're getting back into upper trend. We're starting getting a lot more activity in this space now for clients who's looking to leverage in life insurance purchase. Next, please. Market prediction. Hard to say right now. Too many things happening globally. Again, we all have to look at when you're buying life insurance, whether it's financing and non-financing, you got to look at 15, 20-year time horizon for the plan to really percolate and give you growth opportunity. Okay. Next. You can skip all this. Let's go to the last session because I want to talk about the index. Next. Last session, Gina.
Yeah, pulling it up. Give me 1 second. And
Okay.
Vincent,
Take
you've
your time.
actually run out of time. So
We have time?
you've actually run out of time because it's only 15
Oh, I
minutes.
did. Oh, I'm sorry. All right. Do
Yeah,
we have at
yeah,
least 5 more minutes? 5 more minutes?
yeah, five. So give me 1 second. I'm
Okay,
just
okay.
okay. So
If you
index.
can do 5, I don't need the screen. I'll just talk about the S&P 500, okay?
Go ahead. Okay, go ahead.
So Index Universal has been probably the last 15 years, one of the most popular life insurance strategy for someone that say, I want to have growth opportunity with no downside risk. What that means is the initial chassis is S&P 500, and so it protects the downside. That means the market goes down. Unlike buying a regular S&P, the way in the life insurance product, if the market's negative, it guarantees zero. And then when the market goes up, most companies has a cap. Over the last 4 or 5 years, some very good companies that we have access to has uncapped strategies with some really robust returns. But I'm going to just talk about the normal ones, okay? In the last 30 years look back, the S&P averaged 12.49. The index, because there's caps in most of the companies, the average was 7.10. The best year is 32% on S&P in 2013. So the index at that time was 10%. The worst was minus 37% in 2008. But with the index universal life, it's guaranteed zero. But by working with us, Jerry and I have access to some proprietary carriers for index universal life that only 2% financial advisor in the United States has access to it. We have strategies that we have Goldman Sachs, New York Stock Exchange, JP Morgan, BlackRock. We can offer things that most of those other S&P IULs don't have. So we can get rates with historical 10 to 12%. So if you're getting a 7, we give it 2 to 3% more in return. Your premium financing policy or the regular IUL purchase becomes a really good asset class. Okay, so that's it. I'm within 5 minutes, Any questions from the audience?
Good high-level overview. Mr. Dean, do you have any
Yeah.
questions?
No. I miss a part of it, but it's very, very interesting. And I'll talk to some of my people. I think it would be a good idea if you guys do it again. You
Okay.
know, if you set it up for another time, so I can get some of these interested party online with you.
So what I'm thinking,
Sounds good.
Dean, is that we do a smaller session for some of the individuals. So if you could get a timing and together in terms of when they're all available, we could do a smaller session.
Okay, I can do that. I can do that. I'll set it up and let you guys know, and then you can set up a time and when you can redo this very interesting information and investment.
Thank you.
Sounds good,
Swarnam?
Mr. Dean.
Yeah, thank you. Swarnam, you have any, just maybe a few questions? 'Cause we only have 10 minutes.
Yes, yes, we have a few questions from online.
Okay.
So, one of the questions that we received are, what are the main risks HNWIs should be aware of when using premium financing strategies?
I would say the main risk is the loan interest rate. That's the bigger one. So that one we really don't control as much because that's controlled by the politics, the Feds, and that pass down the loan rates to the lenders, whether it's private banking or private uh, or companies that strictly do premium financing. Okay, but we always talk about historical, right? Because everything else we do in our strategies, whether it's buying index annuities or variable or non-variable, we look at 20, 30-year history because people are looking to do long-term planning. If it's a short-term planning, premium financing is not the right strategy. It has to be
Mm,
something that's looking for an ultimate goal, tax planning or retirement planning or combination.
okay, thank you. Thank you for that.
Next question.
Another question that we received is how can HNWIs negotiate or structure loans to minimize the long-term cost of borrowing for premium payments?
Okay. So we will look at first is, what's the ultimate goal first, right? Whether it's designed for tax purpose or it's designed for a cash accumulation for either retirement or just used as an asset class. Then we look at the age of the insured that's looking to purchase this policy, right? How we customize it and do they have some liquidity of asset that they can use as a self-fund on part of it, right? So that way the loan exposure on the debt is lower. Um, so each situation vary. And by the way, any structure we set up in year one can be changed. It's all flexible. Whatever we do, it's not locked in. Whatever we set up, it can. If your lifestyle change, the family dynamics change, that can also be adjusted each year.
And Swino, maybe one more question, please.
Yes. Winston, so what
Yes.
major events like 2008 crisis or COVID-19 have on indexed IUL returns?
No, great question. So when the market went down with IUL, okay, so let's say I show you that 32% was the negative in the S&P that year. Anyone that had IUL in 2008, or depends when they purchased it, it's what they call point-to-point time frame, 12 months. They had a zero. It's a flat, no gain, no loss.
Mm,
They just take out the cost for the insurance for that year. But the value of the account did not have a dramatic like 30% drop in the value. But if you're in a regular S&P mutual fund, you would have dropped 30% in the value.
mm,
So that's the advantage of having an IUL life insurance, the way you have structured the product.
All
well,
right, thank you for that.
Yeah.
Yeah. We have time for one more, Swarnam. So one more, and then we'll wrap up and then share where we're going to share the PowerPoints and notes from the session.
Sure. How do rising interest rates influence the performance and cost efficiency of a premium financing strategy?
Okay, great question again. So the loan rate, like for example, this past few years, the loan rate's been in the high six, right? But if we the way we do the premium financing, we're looking to get maybe a 7% return on the S&P strategy, right? But if we can get 9 to 10 from our proprietary strategy, what happened is now the loan rate is not a factor, right? Because you're gaining cash value growth. But if your investment return and the loan rate is pretty same, then you're a little bit not on the right track. What we try to do is make sure we can select the right strategy based on the client's risk tolerance, and those strategies can be changed either every year or every 3 year, depends what we design it, or it could be multiple, some 1 year, some 3 year strategies. Okay.
Thank
We have
you.
some companies, I'm sorry, we have some company that has uncapped strategy where they earn 50, 60% return on their IUL. So if you need 1 year of that, it makes up for multiple years of growth.
Wow.
Okay, so so Mr. Dean, we do is when we finalize with a client, right? Let's say you decide, okay, how much face amount you want, and we can get engaged. Then we'll go to 5 major companies that are the best in IUL space in cost,
Mhm.
not in the premium. Because if let's say 5 companies, 100,000 premium as an example, each of
Yeah.
them internally have different costs. So we'll go to the 5 lowest costs internally because the least cost is that means there's more money to invest in the market. Okay.
Mhm.
So as the
Okay.
independent advisor, we have access to that.
Very good.
Okay.
Very good. I find it very interesting.
Okay.
All right.
I think we will wrap up. So to say thank you to everyone who joined us tonight. We'll be sending out the notes. And if you find this of value, if you found tonight of value, there'll be more. So please follow us on our LinkedIn advisory page and also follow us on our Instagram page. And we'll be sharing more. We'll start in September on a monthly cadence. But we will send through the PowerPoint as well as the recording and notes to you via email. So thank you and good night from Abu Dhabi.
Thank you.
Thank
Good
you.
night.
Thank you, everybody.
Good morning from
Okay.
us.
Thank you. Thank
Take
you.
care. Thank you, everybody.
Thank you
Very
for joining,
interesting.
Mr.
Very
Dean, and
interesting.
Yeah.
thank you for
Thank
joining,
you.
Mr. Dean, and we'll talk with you later.
Okay, my
follow up.
friend. Peace and love.
Okay. Thank